Hey Hannah, thanks for joining me today.
Thanks for having me. Looking forward to sharing some insights.
Let's talk about current liabilities. What do business owners need to understand?
Current liabilities represent immediate financial commitments that businesses need to address within the next 12 months. This includes everything from supplier payments to employee wages and taxes. Understanding these obligations is crucial for maintaining strong business relationships and credit standing.
So, how does this impact day-to-day operations?
The impact on business operations is actually really interesting. When we look at daily operations, it's straightforward. Your current liabilities, think supplier payments, payroll, upcoming loan payments. They create a financial framework for your business. Having a clear picture of these obligations is crucial for making strategic decisions. Something I always emphasize to clients is the cash flow perspective. Most businesses think about when money comes in, but timing your payments strategically is equally important. It's about creating a rhythm that works for your specific business model. And what really matters is how this affects growth potential. I recently worked with a retail business that was hesitant to take on new opportunities because they were so hyper focused on their current obligations. Once we reconstructed their payment timing, they had the confidence to expand. It's not just about pushing payments out, it's about being strategic. And understanding your obligation helps you make informed decisions about when to take on new inventory, when to invest in equipment, or when to seize growth opportunities. From a lender's perspective, we look at how businesses manage these obligations. It tells us a lot about their financial acumen and readiness for growth financing.
Can you explain how working capital fits into this picture?
Yeah, working capital is your operational firepower. It's the difference between current assets and current liabilities. Think of it as your company's ability to seize immediate opportunities. Whether you need to purchase inventory in bulk, upgrade equipment, or fund a major contract, your working capital position determines how quickly you can act.
What's a common misconception about working capital?
A lot of business owners think working capital is just about having money in the bank. That's actually one of the biggest misconceptions I see. So working capital is more like your business's breathing room. It's the difference between what you can quickly turn into cash, your current assets, and what you need to pay soon, your current liabilities. Another common mistake is thinking you only need to focus on working capital when you're struggling. I see this with successful businesses all the time. They're profitable, but can't figure out why they're still stressed about cash flow. So I'm going to give you an example. I work with this e-commerce company that sells luxury candles. Their sales were growing like crazy, but they were constantly stressed about money. Why? Because they had to pay a manufacturer 60 days before getting paid by their customer, a very normal working capital gap. So we help them set up a line of credit specifically for inventory purchases. They can now take advantage of bulk discounts from suppliers and have the flexibility to launch new product lines without the constant financial stress. That's why I tell clients your working capital needs to match your business model. There's no one size fits all solution. What works for a retail store won't necessarily work for a consulting firm. And the goal isn't just to have more money. It's about having the right financial structure that lets your business operate efficiently and take advantage of the opportunities when they come up.
Let's talk about measuring business activity. What should owners focus on?
Business activity is the core engine that drives your company's success. It includes everything from production and sales to service delivery and customer interactions. What's crucial is understanding your unique patterns and competitive advantages. When we analyze business activity, there are a few key metrics that immediately tell us how a business is performing. So first, you want to look at your revenue patterns. Not just the total number, we're looking at trends. Are your busy seasons getting busier? Are your slow periods starting to pick up? This tells us if your core business activities are gaining momentum. Next, and this is often a surprise to people, we look at your accounts receivable turnover. Think of it as how quickly you're converting sales into actual cash. I had a client who looked great on paper, but was struggling because their payment collection cycle was too long. The third metric is inventory turnover, if that applies to your business. This shows us how efficiently you're managing your resources. Too high might mean you're missing sales opportunities. Too low could signal cash tied up in unsold products. Then we look at your operating cash flow ratio. This is super important because it tells us if your day-to-day business activities generate enough cash to cover your short-term obligations. It's like taking the pulse of your business operation. What's really interesting, Serena, is your working capital turnover. How efficiently you're using your working capital to generate sales. This is crucial for understanding if you're making the most of your available resources. Last metric, and I always emphasize this one, your operating expense ratio. It shows how well you're controlling costs relative to revenue. This directly impacts how much capital you have available for growth.
What financing options are available for different business needs, Hannah?
Let's start with lines of credit. These work like a financial safety net. You only pay interest on what you use. Perfect for managing seasonal inventory or converting short-term cash flow gaps. Then we have term loans. Unlike lines of credit, you get a lump sum upfront. Great for major purchases or expansion projects. The key here is matching the loan term to the asset's useful life. You don't want to be paying for equipment long after it's obsolete. Equipment financing is often overlooked, but can be really powerful. Since the equipment serves as collateral, rates are usually more competitive. Plus, you can often finance up to 100% of the purchase price, preserving your cash flow for other opportunities. For shorter term needs, there are merchant cash advances. Higher cost, but they can make sense for businesses with strong daily credit card sales who need quick access to capital. The key is just understanding that these options aren't mutually exclusive. Sometimes the best strategy is combining different types of financing, maybe using equipment financing for your production line while maintaining a line of credit for working capital.
How should businesses approach financial planning?
Financial planning really comes down to aligning your capital structure with your business goals. First step is building a rolling 13-week cash flow forecast. This isn't just about predicting numbers. It's about mapping out your operational rhythms. When's your busiest season? When do your biggest payments hit? A lot of businesses skip this and end up reacting instead of planning. Next, you need to evaluate your debt structure. I've seen businesses using high interest credit cards when they could qualify for a line of credit at half the rate. Yes, half the rate.
That's crazy.
Sometimes it's not about getting more capital. It's about optimizing what you already have. Third piece is understanding your collateral position. What assets do you have that could support better financing terms? Equipment, inventory, accounts receivable, these all have value from a lender's perspective. One strategy that's so often overlooked is diversifying your funding sources. A line of credit for seasonal inventory, equipment financing for major purchases, maybe financing for managing cash flow gaps. Finally, you need a trigger system for when to seek additional financing. Waiting until you're in a cash crunch limits your option. The best time to arrange financing is when you don't desperately need it. I always tell clients your financial strategy should support your business strategy, not constrain it. It's about creating flexibility and maintaining control over your growth trajectory.
What practical steps can business owners take to improve their financial position?
Great question. I'm going to share 7 actionable steps that I've actually seen make a real difference for businesses. And if you're still watching on YouTube, stay with us. These are strategies that you can start implementing right away. So first, priority is separating your business and personal finances completely. This isn't just about having different accounts. It's about building a clear financial identity for your business. This single step can dramatically improve your financing options. Number 2, Set up a proper cash flow monitoring system. Third, and this is crucial, start building relationships with lenders before you need financing. I often see businesses scrambling for capital during a cash crunch. That's the worst time to start these conversations. Fourth, review your payment terms, both with suppliers and customers. Often there's room for negotiation. Even small adjustments like extending supplier payments from 30 to 45 days can significantly impact your working capital. Fifth step is establishing a credit building strategy. Start with vendor accounts that report to business credit bureaus, then gradually build up to stronger credit products. This creates a clear record of your business's credit worthiness. Number 6, almost there. Number 6 is maintaining a rolling 13-week cash forecast. This isn't complex, just map out expected income and expenses. It helps you spot potential gaps before they become problems. Finally, set up regular financial reviews. Monthly is minimum. Weekly is better. Focus on key metrics, cash position, upcoming obligations, and any variances from your projections.
Hannah, what trends are you seeing in business financing right now?
The most significant trends I'm seeing are related to major shifts in how lenders evaluate businesses. Traditional metrics like credit scores still matter, but we're increasingly looking at real-time data. Your digital payment history, online sales patterns, even your customer reviews. Yes, those. This is actually opening up new opportunities for businesses. Another interesting trend is the rise of industry-specific financing. Lenders are developing specialized products for different business types, whether you're a restaurant, an e-commerce store, or a service provider. This means more tailored solutions and often better terms. We're also seeing a huge shift toward integrated financial services. Your payment processor might offer you working capital, or your e-commerce platform might provide inventory financing. These integrated options often mean faster approvals and more convenient repayment terms. Looking ahead, automation is going to play a bigger role. We're already seeing this with instant lending decisions for smaller amounts. For business owners, this means faster access to capital when opportunities arise. Supply chain financing is becoming more accessible to smaller businesses. This is huge because it lets you optimize payment terms with suppliers while maintaining strong relationships. It's something that was previously only available to large corporations. Another trend I'm watching closely is the evolution of revenue-based financing. Instead of fixed monthly payments, these structures flex with your business performance. It's particularly relevant for businesses with seasonal or variable revenue patterns. The key takeaway here is that financing is becoming more flexible and more personalized. The businesses that will benefit most are those that stay informed and position themselves to take advantage of these new options.
You've been providing so much valuable information in this call, Hannah. I really appreciate all the time that you've given us. Do you have any final advice for business owners?
Final advice for you. Looking at today's market, the biggest shift I'm seeing is how financing needs to be as dynamic as your business. Most owners are still stuck in this mindset of if it's not broken, don't fix it. But that's leaving money on the table. Let me give you a real life example. I worked with a business just last week that was still using the same basic line of credit they got 3 years ago, even though their revenue had tripled. By updating their financing strategy to match their current size, they cut their financing costs by 40%. The thing is, your credit profile and banking relationships are like financial muscle. They need to be built before you need to use them. That's why smart businesses today are focusing on 2 things: maintaining clean financial data, because that's what gets you faster approvals and better rates in this digital lending environment, and understanding their actual revenue patterns. The interest rate isn't always the whole story. Sometimes a higher rate product that matches your cash flow cycle is actually more profitable than a lower rate option that fights against it. In the the end, financing should be powering your next growth move, not just keeping the lights on.
Thanks so much for sharing your expertise with us today.
Thanks for having me. Remember, understanding your finances is key to business success.
Follow us for more business financing insights.